Chapter 10. Dividend and Interest. Question 6. Justify the following statements. 4 marks each. 1. Dividend is paid out of profits of the company. Answer. 1. Dividend is that portion of the profits of the company which is distributed to its shareholders. 2. The board of directors of the company decides the source out of which dividend is to be paid. 3. Company can pay dividend out of profits of the company for the current year, arrived at after providing for depreciation for the year, and transfer to reserves. 4. Dividend can also be paid out of the profits of the company for any previous financial year or years, arrived at after providing for depreciation and remaining undistributed. 5. Dividend can be paid out of capital profits, that is, profits realized on the sale of business assets, only if the capital profits are realized in cash. The capital profits remain after the revaluation of all the assets and liabilities, and the distribution of dividend out of such profits is permitted by Companies Articles. 6. If there is no profit for the current year, or the profit earned in the current year is not adequate, the company can declare and pay the dividend out of its free reserves, that is, profits accumulated till last year. 7. However, dividend cannot be paid out of capital under any circumstances. It is illegal to pay dividend out of capital, and directors are held personally liable for such payment. 2. Interim dividend cannot be paid out of free reserves. Answer. 1. The dividend, which is declared by the board of directors between 2 annual general meetings of the company, is called interim dividend. 2. It is paid before the finalization of annual accounts, that is, in the middle of the accounting year. 3. When a company makes huge profit in the first half of the accounting year and hopes to continue the same in the second half also, the board of directors of the company may declare interim dividend. 4. Interim dividend is only on account payment of the whole dividend for the year. Hence, it is a part of final dividend. Therefore, while deciding the rate of interim dividend, the size of net divisible profit is considered. 5. Company cannot utilize free reserves for the payment of interim dividend. Free reserves means such reserves which are available for distribution as dividend. 6. Free reserves can be used by the company to declare final dividend, to issue bonus shares, to write off accumulated losses, and to write off share issue expenses. However, it cannot be used for payment of interim dividend. 7. If, after declaration and payment of interim dividend, company incurs losses in the second half of the accounting year, the directors who have declared interim dividend are personally liable to reimburse the amount of interim dividend to the company. 8. Hence, interim dividend cannot be paid out of free reserves. 3. AGM is crucial for final dividend. Answer. 1. Final dividend is a dividend which is declared and paid after the close of the accounting year. 2. After the conclusion of the accounting year and ascertainment of net divisible profit of the company, a part of it is paid to the shareholders as a return on their investment in shares by way of final dividend. 3. The rate of dividend is first recommended by the board of directors and then declared by the shareholders in their annual general meeting by passing an ordinary resolution. 4. In the annual general meeting, the shareholders shall not declare dividend exceeding the rate recommended by the board. However, they may reduce the rate of dividend as recommended by the board. 5. Once a company has declared dividend for a financial year at an annual general meeting, it cannot be revoked, and a further dividend cannot be declared in respect of the same year, at a subsequent general meeting. 6. Thus, annual general meeting is crucial for final dividend. 7. However, holding of annual general meeting is not necessary to declare interim dividend. It can be declared by the board of directors by passing a resolution in the board meeting. 4. Listed company has to follow additional guidelines on dividend matters. Answer. 1. A listed company is a company whose shares are listed and traded on a stock exchange. 2. There are certain legal provisions which companies should follow for declaration and payment of dividend. 3. However, if the company's shares are listed on the stock exchange, it has to fulfill additional requirements as follows. A. It has to notify the date of the board meeting at which recommendation of dividend is to be considered to the stock exchange where company's securities are listed. B. It has to intimate stock exchange immediately after declaration of dividend. C. It has to give notice of book closure to the stock exchange at least 7 working days in advance. D. It must close the register of members and transfer register during book closure. E. It must use electronic mode of payment like National Electronic Funds Transfer (NEFT) or Electronic Clearing Services (ECS) as approved by the RBI. F. Listed companies are required to express the dividend on per share basis only. 4. Thus, listed company has to follow additional guidelines on dividend matters. 5. Equity shares get last priority in dividend. Answer. 1. Equity shares are those shares which do not have priority for payment of dividend or for repayment of capital in the event of winding up of the company. 2. Whereas preference shares are those shares which have priority over equity shares for payment of dividend and for repayment of capital in the event of winding up of the company. 3. The dividend payable to preference shareholders is fixed at the time of issue of shares, and they have a priority over equity shareholders to receive the dividend. 4. The rate of dividend on equity shares depends upon the profits of the company remaining after payment of taxes, interest, expenses, dividend at a fixed to preference shareholders, etc. If there is less profit, lesser dividend will be paid, and if there is no profit, no dividend will be payable to equity shareholders. 5. Equity shareholders bear the ultimate risk associated with the ownership because they are paid dividend from residual profits. 6. If the company performs well, they enjoy greater financial returns. If the company suffers heavy losses, the risk mainly falls on equity shareholders. Therefore, equity share capital is also known as risk capital or venture capital. 7. Thus, equity shares get last priority in payment of dividend. 6. Unpaid dividend cannot be used by the company. Answer. 1. The dividend, which is not paid to the shareholders by the company within the prescribed time of 30 days of its declaration, is called unpaid dividend. 2. When the shareholder does not present his dividend warrant for payment, such amount remains unpaid with the bank. It is then known as unclaimed dividend. 3. When the dividend is not paid to the shareholders, or it is not claimed by the shareholders within a period of 30 days of its declaration, the company has to open unpaid dividend account with a scheduled bank and transfer the total amount of unpaid or unclaimed dividend to this account. 4. This transfer has to be done by the company within 7 days from the date of expiry of the 30 days period provided for payment of dividend. This means transfer should take place within 37 days from the date of declaration of dividend. 5. Within 90 days of the transfer of amount, to the unpaid dividend account, the company has to prepare a statement related to persons to whom unpaid dividend are to be paid, and such statement shall be placed on the website of the company or any other website as approved by the central government. 6. Any amount in the unpaid dividend account of the company which remains unclaimed and unpaid for a period of 7 years from the date of transfer of such amount to the unpaid dividend account should be transferred by the company to the Investors' Education and Protection Fund, that is, IEPF. 7. Thereafter, the claimant of money will have to follow the procedure and submit necessary documents to get claim from IEPF. 8. Thus, unpaid or unclaimed dividend cannot be used by the company. 7. Interest is a liability or obligation of the company. Answer. 1. Interest is the price paid for the use of others' money for a certain period of time. It is paid by the borrower to the lender. Therefore, it is the cost for the borrower and income for the lender. 2. The company borrows money from debenture holders, bond holders, depositors, banks, financial institutions, etc., for business purpose, and pays interest to them as per agreed terms. 3. Generally, the rate of interest is fixed and predetermined at the time of borrowing. Company has to pay interest even if it does not earn any profit. 4. Therefore, interest creates a fixed charge against the profits of the company till the repayment of principal amount. Hence, payment of interest is liability for the company, as it has to be compulsorily paid. 5. Interest is required to be paid every year, irrespective of whether the company earns profit or not. For payment of interest, there is no need to pass any resolution in any meeting. 6. Thus, there is an obligation or compulsion to pay interest, as it is not linked to the profits of the company. 8. Approval of members is not needed for interim dividend. Answer. 1. The dividend, which is declared by the Board of Directors between 2 annual general meetings of the company, is called interim dividend. 2. It is paid before the finalization of annual accounts, that is, in the middle of the accounting year, and prior to declaration of final dividend. 3. When a company makes huge profit in the first half of the accounting year, and hopes to continue the same in the second half also, the Board of Directors of the company may declare interim dividend. 4. Interim dividend is only on account payment of the whole dividend for the year. Hence, it is a part of final dividend. 5. The Board of Directors of the company has the power to declare interim dividend. A resolution has to be passed in the board meeting for declaration of interim dividend. 6. For declaration of interim dividend, holding of general meeting and approval of the shareholders are not necessary. 7. Once the interim dividend is declared by the Board of Directors, it becomes a legally enforceable debt of the company. It cannot be paid out of any free reserves of the company. 8. Hence, approval of members is not needed for interim dividend.